So the areas where employers are nervous and feel tremendous uncertainty are retail and manufacturing. Many of those firms rely on inputs that are imported from abroad, especially from China. And so they are concerned that tariffs could hurt their cost structure. Many companies that have the cash on hand will buy as much inventory at favorable prices when they can. The companies that don't have that kind of cash or those credit lines will be at a disadvantage. The smallest businesses could really suffer if their costs go up.
Julia Pollak joins us today. She is the chief economist at ZipRecruiter, one of the nation's largest sites for actually labor data, which is something that we don't usually think of ZipRecruiter as, but we like to discuss with Julia what exactly is going on with the labor market in America. Welcome to the show, Julia. Good to see you again.
Thank you very much, David.
ZipRecruiter being a hub for people finding, posting jobs, and sourcing jobs, has real-time data that government agencies may not have. But I'd like to compare today your data versus government data that's been released. So as you're aware, the civilian unemployment rate in the U.S. has been trickling down. So we're currently at 4.1% in October. It peaked at 4.3% in July. So that's a couple of months of data of slightly lower unemployment rate. Now, how would you evaluate this? Is this the beginning of a downward trend for unemployment, meaning a pickup in hiring, fewer layoffs, and generally just a healthier labor market in the U.S.?
So I think many have interpreted these top-line indicators as a sign that the labor market is rebounding after a 2-year slowdown. But there actually isn't much evidence of that just yet. So there is reason to anticipate a rebound, right? The Fed has started cutting rates, and that should at some point result in lower borrowing costs, more investment, and more hiring and more business growth. But it hasn't happened yet. What we're still seeing is that the labor market is continuing to slow and slacken, that job growth is now slower than it was before the pandemic. It has for the past 2 quarters been below the pre-pandemic level pace. And also that those gains are very narrowly distributed in government and healthcare, and that other sectors are growing unusually slowly. We've also seen the number of applications per job posting rise, the number of interested job seekers per job posting rise. And so we see clear evidence of continued slack. We don't see the labor market tightening over the past 3 months.
Interesting. I'd like to show you this stat here. This was originally posted, I believe, several news sources posted this, but this is from Yahoo Finance. Pay increase gap between job switchers and job stayers narrows, which is to say people who have found jobs in other places before or switched jobs have had higher wages or a wage growth rate in prior years relative to now. What does this signal to you, Julia?
Right. So during the pandemic, that gap peaked at an all-time high, nearly 3 percentage points, which is unheard of. The employers were paying a real premium for new hires. They had severe staffing shortages, and the first place they looked to solve this problem was new talent, was hiring new people. They made a huge investment in recruitment. They rolled out the red carpet for new hires. They invested heavily in signing bonuses. At some point, more than 12% of job postings listed signing bonuses, and that's unheard of because typically only about 2 or 3% of job postings offer those. So there was just this major effort on the front end. The problem was that because there was still such a tight labor market, many employers got burned. They paid a huge amount for new hires. They alienated existing workers who felt unfairly treated. And then those new hires upped and left within just a few months anyway for a better opportunity. So now companies have, by and large, moved towards focusing on retention, and they're offering more long-term incentives for people to stick around. And that is part of the reason why we're seeing this sort of great stay and this slower labor market.
Is that because there is a shortage of labor, Julia?
So I think the experience of being burned during a very, very tight labor market when there was a shortage of labor has made employers nervous and caused sort of the pendulum to swing all the way in the other direction. As far as shortages go, there are still shortages as far as the eye can see in some industries. In others, like tech and marketing and PR and many of the industries where job growth has been stagnant over the past 2 years, you actually see a surplus of very talented people, of laid off workers who are struggling to find new jobs, despite having fantastic resumes and doing great interviews.
Are you seeing a disparity between the wage growth of, let's say, blue collar workers and white collar office workers?
Yes. So many blue collar fields have seen wages grow faster than inflation, some even faster than the pre-pandemic trend. So most workers were used to receiving real wage gains before the pandemic, but some are now seeing even faster gains. And by and large, white collar fields have actually seen slower than inflation wage increases, nominal wage increases. So real wage declines in tech and information and journalism, the media. The wage gains have been quite slow since the pandemic.
Which sectors would you think have the highest chance of growth going forward, based on the data that you're seeing?
Sure. I mean, so based on the results of the election, based on the initial sort of change in sentiment among employers, it seems like banking and financial services have received the biggest boost from the election. They anticipate less strict financial regulations and also a more permissive attitude towards deal making, towards mergers and acquisitions. And that is boosting stock prices and employer giddiness. So that's one area where we think conditions are likely to improve in the coming months for job seekers.
I guess the counter question to that is areas or sectors in which you see the least growth or perhaps more layoffs into the future.
So the areas where employers are nervous and feel tremendous uncertainty are retail and manufacturing. Many of those firms rely on inputs that are imported from abroad, especially from China. And so they are concerned that tariffs could hurt their cost structure. In the past, in the last Trump administration, companies dealt with that often by buying inventory, a huge amount of inventory up front, paying large storage costs, making big bets on what consumers would want in the future. That is likely to happen again now, especially given the experience that companies had of sort of tariffs turning on for a couple of months, then turning off, and their prices and costs changing from month to month. To lock in certainty, many companies that have the cash on hand will buy as much inventory at favorable prices when they can. The companies that don't have that kind of cash or those credit lines will be at a disadvantage. So perhaps the smallest businesses, could really suffer if their costs go up.
Julia, let's talk about what you think the next Trump administration may or may not affect, or how it may or may not affect the labor market. As you know, you brought up tariffs, are a concern for some businesses. I've been reading some businesses are pulling forward their inventory, stockpiling now versus when stocks may increase in price later on. That's their anticipation. What about hiring and firing decisions ahead of tariff implementations? Would that change anything?
So there are several surveys now that ask employers how the election is going to affect their business, and most say it will not affect their hiring decisions. Very few say it'll affect their investment decisions. Of course, there are some industries that are very directly affected. Some green energy companies that heavily rely on subsidies that are nervous and that will put investments on hold until they have more clarity. There are private prison companies that are very excited about the election result. Not so much the national result, but some of the local results, the local ballot measures, the tough on crime measures that won bigly, and that will result in tougher sentences likely and longer prison terms, or prison terms rather than no prison terms at all. So there are some industries that are likely to see a big change in demand and to change their hiring accordingly in the coming months. But most of the labor market is not really going to be affected. And I think one important thing to think about is, in some ways, this is a status quo election when it comes to labor market institutions, things like minimum wages and unionization rates, right? California will continue to be California. It doesn't matter that Donald Trump is in the White House. They can continue to have high minimum wages and pro-union policies. Red states can continue to operate the way they operate, with much looser regulations and with that $7 federal minimum wage. So, if on the other hand we'd had a blue sweep, that I think would have meant more changes for the labor market, because the Democratic administration would have tried to push for federal standards in the labor market, for a federal minimum wage of $15, for more pro-union policies nationwide, and that would have pushed red states towards the California model and increased the cost structure for many companies that traditionally have had low labor costs.
Okay, well, I think people in the labor force would like to know where their real wages, which is wages adjusted for inflation, may climb or decrease into the future. So this is median weekly real earnings, wage
Right.
and salary of workers over the 16 years of age, from the St. Louis Fed, and it's been ticking up. This is of course
Mhm.
indexed to a certain base year. So people have been, according to this data, earning a little bit more adjusted for inflation. Does ZipRecruiter data support this?
Yes. So workers received real wage declines for 25 months during the pandemic because inflation got out of control. But for the past 17 or 18 months, they've actually seen their wages increase more quickly than inflation. In other words, wage growth has slowed less than price growth. And as a result, workers are now coming out ahead. For many, it's going to take a couple more months of this before they really feel made whole. And in the last month, workers received real wage gains of 1.4%. That's about the rate they got used to between 2013 and 2019. And finally,
Mhm.
and I think that'll make workers feel much better about the economy in the coming months if those gains are sustained. Will they be? I think so. So it looks like the progress made on inflation is actually sticky. It's not just that inflation has gone down, but it has narrowed. Most categories are not seeing inflation above the Fed's 2% target anymore. And the only area where we still have a problem really is housing. And the Fed's interest rate hikes didn't really do much on that front. In some ways, they made the problem
Mhm.
worse. So it is time now for governments outside of the Federal Reserve to take a very careful look at the major source of inflation in the US economy, which is housing, and find a way to help states and municipalities build, baby, build.
Build baby build. Is that going to cause inflation overall? If we build baby build the workforce, okay, suppose we have real wages tick up. Have you noticed or observed a correlation between real wages and the inflation rate overall? In other words,
Right.
does the theory of higher wages causing higher inflation, does that actually hold in the real world?
So right now, the labor market does not appear to be inflationary. It's not a source of inflationary pressure. Um, Productivity growth is tracking at about 2.5% a year. Now, theoretically, wage growth could be 2% to keep pace with inflation, and another 2.5% to reward workers for productivity without inflation. Unit labor costs have been going down because productivity is going up. So no, I don't think at the moment that there's a risk of wage growth causing inflation. And since we are not likely to see, high federal minimum wage, I don't see policies that are likely to lead to massive spikes in wages. Now, the one area where economists have voiced concern, well, two really, about inflation are tariff policies and immigration restrictions. So if people do begin to sort of self-deport and go back to their home countries. There are industries that are quite heavily reliant on immigrant labor, and not just immigrant labor, but also unauthorized, illegal immigrant labor, that could see a decline in labor supply that is large enough to cause wages to go up.
Julia, let's talk about the topic of immigration. Trump has tougher immigration policies than perhaps the previous administration. How do you see immigration changing over the next 4 years? In particular, in regards to the deportation threats that Trump has made, how would that change the labor market if it were to be actually implemented, Julia?
Right. I mean, so there are several industries that do rely quite heavily on immigrant labor, and overall, the authorized visa eligible workforce it will not change much. But over the past administration, the numbers of unauthorized entries were, I mean, off the charts, and that clearly has had some effect on labor supply. How many industries are affected and how much? It's not clear because there isn't a good source of data on the numbers, right? The whole this is not an area that's well documented, so we don't fully know. Um, that said, the there are alternatives to illegal immigrant labor. Some include legal immigrant labor. So we might see businesses push for more visas. I think that would be a good move. As an immigrant worker, I fully support increases in some of the quotas and I support skills-based immigration. I think it's silly for the United States to invest a lot in educating foreigners only to force them to go back to their countries when we could use their skills and expertise here. So hopefully we'll see some change on the legal immigration front, not just on what happens to illegal immigrants.
Julia, what is the biggest danger right now, you think, to this, I don't want to say rosy picture, but this optimistic picture that you've painted for the current situation of the labor force right now? In other words, what could derail this growth into 2025?
So, I mean, I think the tailwinds behind this economy are formidable, right? More than a year now of real wage growth and expanding consumer power. Um, uh, a business-friendly policy regime that is likely to allow for faster job growth. What are the risks? I mean, there are always risks. Typically, those sort of unknown unknowns are the scariest of all. Cyber attacks, pandemics, etc. Those risks always exist. Outside of that, the two issues that I think are remaining problems are oil prices, right? They are outside of our control largely and can lead to a cascade of problems across the economy and fuel inflation. And the other is just housing policy. Now, it's hard for the federal government to do much about housing policy because it is set at the state and local level. But there are some fantastic proposals, like some from the Economic Innovation Group, about how the federal government could incentivize local municipalities to adopt best practice building and zoning codes and allow for more building.
One more chart I'd like to show you, Julia. This is the quits rate. So I'm getting different interpretations of the quits rate. Now,
Right.
you told me earlier that the staying power of workers right now is a little bit higher. Employers are paying them a little bit more. So is that quit rates a reflection of employers paying them more now, and so people are less likely to leave, or is that which is a good thing, or is that just people in general having less confidence that they're going to find a better job in the workforce, which may be a bad thing?
Right. So that's the big question. Typically, quits rates are pro-cyclical. And so when they go down, it's a bad thing, and it's a sign of more labor market slack and fewer opportunities. There is some thinking that perhaps this time, the fact that it didn't just decline to the pre-pandemic level, but more, is because there have been some structural changes in the economy, like a major shift nationwide to remote work. Now, in an individual company, if you shift all their jobs from in person to remote, you see a massive decline in attrition, sometimes 30% or more. Right? If you take call center jobs and you tell all those call center workers you can work from home on a cell phone with your dog at your feet, with the TV on in the background, with a chicken in the oven and a load of laundry in and a sick kid next to you, they will take that opportunity and they won't easily give it up. And so it is possible that some of this is for good reasons, but probably the magnitude of the negative effect is bigger. So we've actually at ZipRecruiter just been working on a study to try to tease out exactly this issue. We've looked at an employer survey and we've asked businesses what's happened to their turnover rates. We find that the largest declines in turnover have been in the sectors that have seen the largest slowdown in hiring. So the greatest increase in slack, the largest decline in employer demand, and the sort of greatest deterioration in conditions. But we also see a big decline in turnover in the government, which is a sector where wages have been growing faster than private sector wages now and catching up. So where the sort of differential has shrunk and where jobs have become relatively more attractive in recent years. So clearly both things are important factors, but it seems like labor market slack and sort of cooling conditions are the bigger driver.
Okay. Going back to the unemployment rate one more time, I showed you this chart earlier. What do you have an idea of what a neutral rate of unemployment should be? In other words, full unemployment at which inflation doesn't run too hot, and of course, an unemployment rate that isn't too high, such that we have a deteriorating labor force and a loss of confidence in jobs.
So in the 2017, 2018, 2019 period, we actually did see unemployment dip below 4% without fueling inflation.
Mm.
And one reason is that the willingness of Americans to work constantly surprises economists. So when labor market conditions became more favorable, when unemployment dipped below 4%, working conditions became so pleasant and good and attractive that many people on the sidelines, especially women and especially parents, came into the market. And there's no reason why that couldn't happen again. Women's participation in Canada and that in the United States tracked each other for a very long time in the 90s and then somehow broke apart with participation for women in many peer countries rising above that in the United States. So it looks as though we still actually have room to grow.
Finally, Julia, on the topic of AI, you've heard this many times, of course, the fear that AI will take our jobs. I believe Elon Musk was asked this at a forum. Somebody said, "Is there no hope for any of us?" And he just said, what? Maybe we'll find a clip of that. Anyway,
Right.
What is your personal assessment of whether or not the unemployment rate would actually be affected by automation?
So, given that we have this shrinking working age population, declining birth rates, et cetera, I think without AI, we would have a situation where we would become more and more like Europe with large labor shortages in certain fields. So on the one hand, it's possible that AI could help alleviate some of those shortages and allow for continued output growth in fields that would otherwise be sort of choked off. Do I see AI stealing everyone's jobs? There isn't much evidence of that yet. And, people have predicted this time and time again with labor-saving technology over the centuries. And instead of eliminating all jobs, what has happened is, yes, that certain kinds of jobs were eliminated, and there have been periods where overall employment declined as the result of new technologies. But those new technologies also changed the world and created new needs and new desires and new kinds of work. So, we now in 2024, after waves and waves and waves of automation, have a situation where the prime age employment population ratio is very high, where the women's rate is about the highest ever. So I think the fear is overblown, frankly.
What is your longer term outlook for the labor force participation rate over the last couple of decades? As more women enter the labor force participation rate has moved up dramatically since the 60s and 70s. I believe it peaked a few years ago. Uh, what's your assessment of this trend going forward?
So overall, labor force participation is projected to decline because we have an aging population, and it's rapidly aging now. Right, 2024 to 2027 are known as peak 65. They're the
Yeah.
years in which the largest numbers of Americans will turn 65 and retire and age out of the workforce. So participation will fall for that reason alone. But looking at prime age participation purely, um, there are reasons to believe that women's prime age participation will continue to rise. Women increasingly see themselves as career people. They're delaying having children, they're delaying marriage, and they're prioritizing careers. And more, their workplaces are becoming more accommodating and more sort of more female friendly. Um, often there's a virtuous cycle that sets in when an industry reaches about 20% women. Well, the whole place changes, and suddenly you have, women's bathrooms, and you have more flexible working schedules and that kind of thing. So, I think it's likely that we'll continue to see female-dominated industries grow the fastest, like healthcare. We'll continue to see male-dominated industries become more and more gender balanced. And we'll continue to see women's participation rise. The big question is what's going to happen to prime age male participation. Men are trailing behind women in education. There are the numbers of men who are neither in education nor in employment keep rising. Drugs and alcohol and those kinds of issues affect men more than women. And so we do have a problem that we clearly need to solve in the US economy, which is this underperformance of men.
Last question then. This underperformance, what could be done, if anything, to address that issue?
So I think a major reason for it is that the kinds of work opportunities for non-college educated men that were attractive in the past have suffered most due to automation, right? Manufacturing and construction and those kinds of fields. And so, it's hard to know exactly how to bring those back. One way to fix things might be to bring like auto shop type classes back into schools. There are huge labor shortages in the skilled trades. We know that engineering firms and firms seeking carpenters, electricians, CAD technicians, etc., are having the toughest time filling roles. Plumbers are routinely making six figures these days because they're in such short supply. So having a way to get more vocational training to non-college educated men in high school and afterwards, I think could really turn things around.
Julia, excellent analysis. Thank you very much. Where can we learn more from you and read your work and from ZipRecruiter?
Sure. So our website is ZipRecruiter-research.org. That's where our surveys and our other economic studies are published. And of course, ZipRecruiter.com is where you can find out how to hire and how to post jobs.
Thanks very much.
Or look for a job.
Yeah, well, great resource ZipRecruiter has. So I encourage everyone to check that out. Links down below. Thank you, Julia. Thank you for your time.
Thank you very much. Take care.
And thank you for watching. Don't forget to like and subscribe.